If I told you you could make money when the market goes up and save money when the market goes down, would that be an investment strategy you'd be interested in? Welcome into the Money Vehicle Movement podcast, the show where we break down complex financial strategies to show you how to speak money and act wealthy. I'm your host, Jedediah Collins, the fullback of finance, former NFL, current certified financial planner, and your financial educator. Today, we're diving into a powerful tax strategy that can help you gain more from your losses. This idea is called tax loss harvesting. Let's begin with the idea of a taxable event. We know that even though the price of your asset may have gone up, you do not make money until you sell the investment. This is what is known as realizing the gain. Before you sell the investment, your gain is quote unquote unrealized and not a taxable event. For example, you bought stock A for $100 and then sold it for $120. Booyah, you have just realized a $20 gain. That $20 gain is identified in your taxes as a capital gain. If you have held that investment for less than 1 year, that gain will be deemed short term capital gains and will be taxed as ordinary income. If you, like an investor, had a long term mindset and held that investment for longer than 1 year, it would be deemed a long term capital gain and would be taxed differently than ordinary income. It would be taxed at a 20% or possibly even 15% bracket. That is less than most of income tax brackets, being 22, 24, up to 37%. If you're wondering, can I get a 0% capital gain? Yes, you can, and it depends on your income level. The question today, though, is what happens when you sell something at a loss? Now you bought stock B that was worth $100. Unfortunately, it's now only worth $90 when you sell it. You have now realized a $10 capital loss. Why would anyone want to sell something at a loss? Because this strategy is selling not because you need the cash, but because you want the strategy. Of course, losing money and selling at a loss is never ideal. No one wants to lose. But this is strategically not to lose money. This is to build a tax plan. When you sell a security at a loss, you generate a taxable loss that you can now apply to offset any realized taxable gains. Let's go back to our examples. Imagine you had those two stocks. This year, you sold stock A and had a $20 gain, and then you sold stock B and had a $10 loss. By selling both this year, you can net out those gains and losses, and instead of having a $20 taxable gain, you would only have a $10 taxable gain because the $10 loss would net out 10 or half of that gain. When you begin to look beyond this year and into your investment portfolio of the future, we start to introduce tax loss harvesting. Simply put, tax loss harvesting is a strategy where you sell an investment at a loss to offset future capital gains, not this year, future capital gains. This isn't about losing money, it's about reducing your future taxable income, which will save you money in taxes. If you have more losses than gains in a specific year, you are able to bring any excess loss not used in that year forward indefinitely. You heard that correctly. Indefinitely carry your losses forward. When you carry more and more losses into the future, it is known as harvesting the loss. Harvesting means in future years when you realize massive gains because you're an investment guru and your portfolio is popping, your loss carried forward from the past will reduce your capital gains tax in the year of your gains. So if this year you had $500 of losses more than any gains, you could take that $500 loss forward with you indefinitely. Harvesting your losses then is building a powerful tool for long term tax planning. Not just did I make money, but how can I mitigate and lower my tax liability? We do need to point out that there are complexities with short term and long term transactions in which they are allowed to offset and not offset. So that is why harvesting your losses should always be discussed with a CPA. But harvesting these losses allow you to keep more of your money this year while potentially saving you thousands in the future on taxes. Harvesting allows investors to fine tune their portfolios for tax efficiency while maintaining exposure to growth markets. Remember, you are still creating dollars as you produce this strategy. But this netting out gains from losses gets even better. When you consider that your losses exceed your gains in a year, you can now use up to $3,000 of those losses to offset not capital gains, but your ordinary W 2 income. So each year you have a harvested loss, you can offset or reduce your taxable income up to $3,000. That is why tax loss harvesting becomes such an asset. A quick word of caution: you need to be mindful of the wash sale rule. This IRS regulation prohibits you from repurchasing the same or a substantially identical security within 30 days before or after selling for a loss. That wash sale rule means you just sold stock B for $90 the next day or for the next 30 days. You cannot buy back stock B or a identical company or mutual fund to stock B for the next month. You can't just sell, get the loss, and then get right back in. That is going to take a month to go through. If you violate the wash sale rule, you will lose the deductibility and the offsetting of this strategy. That's why expertise and careful planning are essential when executing tax loss harvesting. The key benefits of tax loss harvesting: you make money when the market goes up and you save money when the market goes down. Think about that idea. Number two, you can reduce your current capital gain taxes from netting your capital losses this year. Number three, you can reduce your ordinary income up to $3,000 each year. If you've harvested thousands of dollars of losses, you can bring that forward each and every year indefinitely. Last but not least, you can carry those future losses through and with you indefinitely. Got to say that one again. In summary, tax loss harvesting is a powerful legal way to stay in the market while reducing your tax bill by turning investment losses into harvested savings. Thank you for tuning in to the Money Vehicle Movement podcast. Be sure to subscribe if you learned something, and go ahead and share it if you think anybody else would be interested. My name is Jedediah Collins. If you want to do me a favor, give it a like.